Canada's interest rates are rising. What does that mean for you?
Hello everyone, we're Claudia and Jose from Castillo Pardo Group, and today we want to shed some light around the news that the Bank of Canada has raised its benchmark interest rate to 0.5%. Whether you're looking to enter the real estate market or have already purchased a property, you may have many questions about what that increase means for you. For this reason, we have decided to chat with Stefan Borgers, mortgage specialist at RBC, to help us break down what this really means for you.
Stefan, let's get into it. What does an increase in interest rates mean for people who already have a mortgage?
Yes, thank you so much, Jose and Claudia. Really happy to be part of this conversation. Well, what does it mean? I mean, we've as you just mentioned, we have seen an increase by 25 basis points just announced. I believe it was on Wednesday, March 2nd. And what does that mean? That typically means that bank prime rates will also increase by 25 basis points. So as a result, that will directly affect individuals who do have a variable rate mortgage because of the fact that that bank prime rate is directly related to that variable rate itself. So, and I think we're going to touch on that in a bit, but essentially mean it's an increase in rates for everyone across the board in a sense.
Okay, so yeah, our next question was that are both variable and fixed affected by this change?
So I guess that the technical answer to that would be no. Variable rates will be directly affected. So anybody who does have a variable rate mortgage, whether they're applying for a variable rate mortgage, whether they already have a variable rate mortgage, since that variable rate is, as I had mentioned, a result of a discount off of what bank prime rate is, that will, that end result, that end calculation, that end rate essentially will be an increase of 25 basis points. However, fixed rates on the other end are truly based off of bond yields. So to have a direct effect to a change in fixed rates, there would usually be some sort of change in the bond market in order for there to be any increases or decreases in the fixed rate market. Another thing actually to mention, I would say, is that a change in the Bank of Canada overnight rate would usually cause some sort of a ripple in the economy as well. So you could maybe expect some sort of indirect effect to fixed rates themselves, or rather to the bond market, which would therefore affect fixed rates. However, as I said, the answer is no. There's not a direct effect to fixed, but variable rate, absolutely.
Okay, and will this increase affect mortgage qualification for home buyers that haven't purchased a home yet?
Really good question. I would say, again, to that, I would say no. And the reason being that mortgage qualification is truly based off of a stress test rate that is established by the Bank of Canada, by the federal government, essentially. And right now that stress test rate is 5.25%. So assuming the variable rate does not is not higher than that stress test rate, which right now it's well below. All mortgages, as far as we know, will really truly be based off of an interest rate of 5.25%, and therefore, this recent change that we've experienced, it's really not going to affect mortgage affordability. Besides the fact that individuals might feel a little less comfort in terms of having potentially a higher payment based on that interest, but affordability not to be affected.
Perfect, Stefan. Good to know. Also, can you tell us what this means in terms of numbers? For example, would a person who pays, let's say, a mortgage of $2,500 or $3,500 per month see their monthly payment increase?
Again, a really good point to bring up. Individuals who already have an existing mortgage segment, who have a variable rate right now on a mortgage, their payments should not increase. They should be keeping that same payment throughout the remainder of their term. However, within that particular payment, the amount that goes towards interest versus the amount that goes towards principal is what will actually change. To give you an example, somebody who's paying $2,500 a month, they can expect an increase of about $75 that would be going towards interest. Somebody who's paying about $3,500 a month, they can expect an increase of about $110 within that payment. Now, outside of that, individuals who are, let's say, applying for mortgages and don't yet have a term or a payment that they're currently obligated to pay, they can expect an actual increase in that actual payment amount. Since the mortgage itself hasn't been activated, and as a result, we would certainly have to increase that payment to reflect whichever amortization they would end up choosing.
Okay, and just to clarify, in regards to that increase of 75 or 110 that you mentioned, it would be in the allocation of the interest versus principal, not on the payment itself.
Yes, correct. Yeah, sorry about that. So that $75 on $2,500 and that $110 on $3,500 monthly payment would be all going towards interest. So that would mean that a smaller amount goes towards principal, and mathematically speaking, the amortization of the mortgage would also increase. Since we haven't changed that payment amount, right? For instance, $2,500, it's still the same amount. Let's say it's coming out once a month. And let's say somebody had an amortization of 25 years, they could probably expect their amortization to increase by, I would say, close to a year. I think around 11, 12 months, give or take, is probably what the math would be on that. So normally if they just log into their online banking, you would see that increase in amortization. However, your payment would still be that same $2,500.
Well, that's because, of course, those are for mortgages that already exist. But if a person was going to get a mortgage last year in December and now they're going to get it now, well, with the new increase, then you're going to have that extra 75 or 110, right? If it was before 2,500, then now it's going to be 2,575. And if it was before, it was going to be 3,500. Now it's going to be 3,610, right?
Exactly. Yeah. So somebody who had a pre-approval, for instance, right, that was based on that previous lower rate before the hike, they would experience that immediate effect to their payment of, $2,500 is now $2,575, for instance. I know that in some instances, and, I can't speak for every institution, of course, but in some instances, if you had already signed an agreement, a mortgage agreement with that specific payment based on that previous rate, assuming you activate within the allocated amount of time, you may still be able to maintain that same payment. But for individuals who don't have any signed agreements in place before March 2nd, would likely suffer that increase to their payment amount.
Okay, great. Well, Stefan, that was very informative. Thanks for explaining the interest rate increase into more detail. Every case is different, of course, so that's why it's always important to talk to your trusted experts before making any important decisions. So let's see what the spring market brings, and be sure to reach out to us with any questions and to Stefan Borgers for any of your mortgage needs. Thank you, Stefan.
Thanks again, Stefan. Until the next one.
Thank you so much.
Take care.
Thanks, guys. Take care.